All right, let's dive in. Today, we're going deep on one of the most powerful ways to build real wealth and achieve financial freedom, the dividend growth strategy. Now, this isn't just about stashing away money. Oh no. This is about building a money machine that creates a steady, reliable stream of passive income, the kind of income that can seriously pave your way to an early retirement.
And to really set the stage, let's just let this sink in for a second. This quote from the legendary Charlie Munger is basically the entire game plan in one sentence. At its heart, this whole strategy is really about one thing: patience. It's about letting your money do all the heavy lifting for you over the long haul and just getting out of its way.
So here's our roadmap for today. We're going to start with the dream itself, what passive income is all about. Then, we'll get into the great debate. Should you focus on high yield now or future growth? From there, we'll break down Warren Buffett's personal blueprint, then get into some practical tools you can use to find great companies. And we'll wrap up with what might be the most crucial piece of all, the investor's mindset.
Okay, let's kick things off with part one. This is all about the why. Why are we even doing this? It's about chasing that passive income dream. And to do that, you have to truly understand the, almost magical force of compounding.
You see, most people think their goal is to save a big pile of money for retirement, but this strategy requires a bit of a mind shift. The real goal isn't just the pile of money. It's building a system, an engine, that generates cash flow on its own. It's about creating something that works for you around the clock, earning you money whether you're at work, on a beach, or sound asleep.
Now, this is, a pretty provocative way to put it, but the analogy is incredibly powerful. Think of every single dollar you invest as a tiny little worker. That worker's job is to go out into the world and earn more money for you. And if you take those earnings and reinvest them, you're not just keeping your workers, you're letting them breed. And that's how you build an entire army of capital that just grows and grows.
Okay, theory is great, but let's make this real. Let's walk through a super simple example. Say hello to Brian. He's just starting out, and he invests $10,000 to buy 100 shares in a good, solid company that pays dividends.
So in his very first year, the company pays a dividend of $10 for every share he owns. That means his 100 shares just generated $1,000 in passive income. Now, Brian could go out and spend that money, but he's smart. He's trying to build his army. So he takes that entire $1,000 and reinvests it, buying 10 more shares.
Now, we fast forward to year 2, and this is where the magic really starts to happen. Brian now owns 110 shares, not 100. So when the company pays that same $10 dividend, he doesn't get $1,000 this time. He gets $1,100. His passive income grew by 10%, and he didn't have to do a single thing. His new shares are now working for him too.
And that right there, that is the compounding machine in action. It's this beautiful, positive reinforcing spiral. More shares lead to more dividends, which lets you buy even more shares, which leads to even more dividends. Our job is just to build this machine and then let it run.
This brings us to a really crucial fork in the road. Part 2 is all about the great dividend debate. It's so easy to get obsessed with finding stocks that pay the highest dividend right now. But as you're about to see, that can be a massive trap. The real debate is all about current yield versus future growth.
And you've got two absolute titans of investing on opposite sides of this. On one hand, you have Philip Fisher, a pioneer of growth investing who basically said dividends don't matter that much. And on the other, you have the father of value investing himself, Benjamin Graham, who saw a long history of paying dividends as a critical sign of a healthy, stable company. So, who's right?
Well, to figure that out, let's do a little thought experiment. I want you to take a look at the next slide and just ask yourself honestly, which of these two companies looks like the better investment to you?
Okay, here's the setup. We've got two companies, A and B. They are basically identical twins. Same valuation, same guaranteed growth over the next decade. There is only one tiny difference in how they operate. Company A pays out all of its profits to you as a dividend. Company B keeps every last cent to reinvest in itself. So, believe it or not, in this very specific scenario, Company A is actually the more valuable one. And why is that? Because it gives you cold, hard cash every single year. You can take that cash and immediately buy more shares, manually compounding your own investment and growing your stake in the business faster. With Company B, you're just along for the ride.
But hang on a second. That felt a little too easy, right? What happens when we change the rules of the game? Let's stop comparing two identical companies and instead compare a stable, steady Eddie company to a real, high-octane growth stock.
And this is where things get really fascinating. Company A starts with a nice, juicy 5% yield. After 10 years of steady growth, it's doubled in value, and the dividend it pays is now a 10% yield on what you originally paid. That's solid. But look at Company B. It started with a tiny 2% yield, which most people would ignore. But because it grew so explosively, after 10 years that dividend has grown so much that it's now a whopping 20% yield on your original investment.
So what's the big takeaway here? It's that focusing only on a high current dividend can be a gigantic mistake. The real engine of your future passive income isn't today's yield, it's tomorrow's growth. A company that can reinvest its earnings at a high rate will end up paying you way more cash down the line. The trick is to find that perfect balance of both. So if the key is finding that balance, well, who better to learn from than the master of compounding himself, Warren Buffett? In Part 3, we're going to peek inside his playbook and break down his timeless blueprint for finding these incredible businesses. And this quote just says it all. For Buffett, it's not about what a stock will do next week or even next year. The entire goal is to build a collection of companies whose ability to earn money will be massively higher a decade from now. It's all about that long-term vision.
So how does he find them? He uses 4 deceptively simple rules. First, he has to understand the business. If he can't make a reasonable guess at what its earnings will look like in 10 years, he just moves on. Second, the company needs to have what he calls a durable competitive advantage, something that protects it from competitors for the long haul. Third, it has to be run by people who are honest and who you can trust to manage the business wisely. And finally, number 4, you have to be able to buy it for less than it's worth. That gives you a margin of safety, a cushion, in case you're wrong.
Okay, so we've got the master's blueprint. Now let's move into Part 4 and get our hands dirty. How can we, as individual investors, actually find these kinds of companies? Well, here are a couple of really powerful toolkits you can start using right away.
But first, let's be super clear on what we're actually hunting for. This definition from Thomas Rowe Price Jr. is just perfect. We're looking for companies that have a proven track record of growing their profits faster than everyone else, and, crucially, have a clear path to keep doing it.
One amazing checklist for this is the CAN-SLIM method. C and A are about earnings. Are they growing fast right now and over the last few years? N is for new, a new product, new CEO, something big that's changing the game. S is supply and demand. Are there fewer shares available because the company is buying them back? That's a good sign. L is for leader. You want to own the number 1 player in the field, not the number 3. I is for institutional sponsorship. Are the big money managers buying in too? And finally, M is for market direction. You want the overall market trend to be on your side.
Now, for a more conservative, safety-first approach, we can turn to Buffett's mentor, Benjamin Graham. His rules are designed to find the absolute bedrock of a portfolio. He wanted big, financially strong companies. But look at how strict he was. Rule 3, no losses in the last decade. And Rule 4, they had to have paid a dividend for 20 years straight, uninterrupted. Think about that. That means the company survived recessions, booms, and busts, and never failed to pay its shareholders. Only then did he worry about getting it at a fair price.
Okay, this brings us to our final section, and honestly, it might be the most important part of this entire conversation. You can have the best strategy in the world, but if you don't have the right mindset, none of it will work. Investing success is mostly a psychological game.
And we have to start with Buffett's most famous rule. It sounds almost comically simple, right? But the wisdom here runs so deep. Building wealth isn't about hitting home runs. It's about not striking out. Protecting your capital is everything.
But let's be really clear about what he means. He doesn't mean your portfolio will never go down in value. That's impossible. Markets go up and down. What he means is you must avoid a permanent loss of your capital. You have to avoid those catastrophic mistakes like buying a terrible business or paying a crazy price that take you out of the game for good.
Here's another mindset shift that might go against everything you've ever heard. The common advice is to diversify like crazy, but people like Buffett and Fisher argue for something called focus investing. The logic is simple. Your truly great ideas are rare. So when you find an amazing company at a great price, why would you water down its potential by also buying your 50th best idea? It makes more sense to bet big on the things you believe in most.
And finally, we have to talk about risk. This turkey analogy is just brilliant. Imagine you're this turkey. For 1,000 straight days, you get fed.
You're protected. All the data you collect proves that the farmer is your best friend. Your confidence in this fact gets stronger every single day. And then, day 1001 arrives. And it's Thanksgiving. The turkey's model of the world was about to fail catastrophically. As investors, we have to remember that what happened yesterday isn't guaranteed to happen tomorrow. We always have to be prepared for Thanksgiving.
And just like that, we come full circle, right back to where we started. All of these strategies, all of these mindsets, they are all in service of this one guiding principle. The whole point is to build your compounding machine and then have the discipline and the emotional control to just let it run. Don't let fear or greed trick you into pulling the plug.
Look, building a real, reliable stream of passive income is not a get-rich-quick scheme. It is, however, a get-rich-for-sure strategy, but only for those who are willing to do the work, to apply the principles, and most of all, to be patient. So the only question left to ask is the one right there on your screen. Are you ready?